Welcome to Deep Dive into Finance channel, where we simplify complex finance terms for you. In the vast universe of investing, understanding the lingo can feel like deciphering a secret code. But fear not. We're here to guide you through the financial maze. Our mission? To empower you with the knowledge and confidence to make informed financial decisions. Today, we're turning our spotlight on two key terms that often leave folks scratching their heads: buy-in and buy-out in the finance world. Let's dive right into our first term, buy-in. When we talk about buy-in in the world of finance and investing, we're referring to a commitment. But it's not just any commitment. It's a pledge to support and participate in a particular initiative, strategy, or investment. Picture yourself as an investor. You're not just throwing your money into a venture and hoping for the best. No, you're buying into a vision, a mission, a strategy. You're becoming a part of the journey. Now, buy-in doesn't always have to involve a financial commitment. It can also be the result of a collective decision-making process where stakeholders agree on a specific course of action. This could be anything from a new business strategy to a significant change in company policy. Consider this example. Let's say a tech startup has developed an innovative software solution and is looking for investors. As an investor, when you choose to buy in, you're not just purchasing equity in the company. You're also buying into the startup's vision for revolutionizing the industry, the team's ability to execute the plan, and the potential return on your investment. The buy-in is also prevalent in the stock market. When you purchase stocks, you're buying into a company. You're expressing your belief in the company's management, its products or services, and its potential for future growth and profitability. But remember, buy-in goes beyond mere transactions. It's about belief, trust, and participation. It's about aligning yourself with a vision and being willing to ride the waves, whether they're high or low. It's about taking a leap of faith, firmly believing that your investment, be it time, money, or resources, will yield returns. So that's the buy-in for you, a crucial term in the finance and investing landscape. Now that we understand what buy-in means, let's explore its pros and cons. One of the most significant advantages of a buy-in is the potential for shared decision-making. When multiple investors come on board, they bring not only their capital but also their unique perspectives and expertise. This diversity can enhance the decision-making process, leading to more robust and balanced business strategies. However, shared decision-making can also be a double-edged sword. More voices at the table mean more opinions and potentially more conflicts. This can lead to slower decision-making processes and, in some cases, disagreements that stagnate progress. Another advantage of a buy-in is the possibility of reduced financial risk. By sharing the investment burden with others, each investor's individual risk is diluted. For example, if 10 investors each contribute a tenth of the required capital, the potential loss for each is only a tenth of the total. But as with all things in finance, reduced risk often comes with reduced potential reward. The same dilution that protects against losses also means that any profits are divided among more investors. A buy-in can also provide an opportunity for smaller investors to participate in larger investment opportunities. By pooling their resources, a group of smaller investors can access ventures that might otherwise be out of their reach. However, this pooling of resources can also lead to a lack of control for individual investors. In a buy-in, decision-making power is often proportional to the amount of capital contributed. Smaller investors may find their voices drowned out by those with deeper pockets. Finally, buy-ins can offer a sense of community. Investors who buy in together often share a common vision and purpose, which can create a sense of camaraderie and mutual support. But this sense of community can also lead to groupthink, where conformity is valued over critical analysis and dissenting opinions are discouraged. As you see, buy-in can be a double-edged sword, beneficial in some situations while risky in others. Moving on, let's decipher the term buyout. A buyout is a financial strategy where a company, an investor, or a group of investors purchases a significant portion, if not the entirety, of another company's shares. This strategic move allows the buyer to gain control over the company being bought out. Let's break it down further. Picture a chessboard. Each piece represents a share of a company. Now, imagine one player, let's call them the buyer, starts to gather more and more pieces, steadily increasing their influence on the board. This is akin to a buyout in the financial realm. The buyer amasses a majority stake in a company, effectively taking control of its operations, decisions, and future direction. This strategy can be seen in various contexts in finance and investing. For instance, in the world of private equity, a buyout is a common occurrence. Private equity firms often buy out companies, especially those underperforming, with the intent of turning them around, improving their performance, and eventually selling them for a profit. This is known as a leveraged buyout. In a different scenario, a larger company may buy out a smaller, competing firm to eliminate competition, expand its market share, or acquire specific assets or technologies. This is often seen in tech industries where large corporations buy out innovative startups to gain access to their groundbreaking technologies. On other occasions, a buyout may be initiated by the management of the company itself. This is known as a management buyout. In this scenario, the company's management team buys out the existing shareholders to gain control of the company. This often happens when the management believes in the potential of the company and feels they can steer it towards greater success. The common thread running through all these scenarios is the acquisition of control. A buyout essentially shifts the reins of a company into new hands, opening doors to fresh strategies and potentially a new path to success. And that, dear viewers, is the essence of buyout in the financial world. Having understood buyout, it's time to weigh its pros and cons. Let's dive right in. Firstly, the advantages. A buyout can be a savvy strategy for acquiring a successful business without having to build it from the ground up. It's akin to taking the express elevator to the top, bypassing the arduous climb. This can be especially beneficial if the target company possesses unique resources or capabilities that are difficult to replicate. Additionally, a buyout can provide immediate access to new markets, customer bases, or technologies. Take the example of a tech giant acquiring a startup with an innovative software solution. The tech giant can swiftly expand its product portfolio without having to invest time and resources into research and development. Now, on to the disadvantages. A major drawback of a buyout is the potential for a high initial cost. Buying an established company is rarely cheap, and it can put a significant strain on the buyer's finances. Another potential pitfall is the challenge of integration. Merging two companies often involves reconciling different corporate cultures, systems, and processes. This can be a complex and time-consuming endeavor, with no guarantee of success. The risk of overvaluation is also worth mentioning. When excitement about a potential buyout takes over, it's easy to overestimate the target company's value and pay more than it's worth. This can lead to significant financial losses down the line. Lastly, there's the risk of regulatory scrutiny. Buyouts, particularly those involving large corporations, can attract the attention of regulatory authorities. If deemed to create a monopoly or reduce competition, the buyout could be prohibited, leading to wasted time and resources. In summary, buyouts can offer a fast track to growth and expansion, but they come with significant financial risks and operational challenges. Just as with buy-in, buyout also has its own set of benefits and risks. Today, we've taken a deep dive into the terms buy-in and buyout. We've explored their meanings, their roles in finance and investing, and their respective pros and cons. To recap, buy-in refers to an investor purchasing a stake in a business, often with the intention of having a say in its operations. It can lead to fruitful partnerships and shared expertise, but it also carries risks such as potential disagreements and dilution of control. On the other hand, buyout involves an entity taking over another by buying a majority of its shares. This can result in complete control and the ability to implement strategic changes without opposition. However, it can also lead to significant financial risk and potential difficulties in integrating the two businesses. Remember, both buy-in and buyout come with their own unique sets of benefits and challenges. They are not one-size-fits-all solutions, and their effectiveness depends largely on the specific circumstances and the strategic objectives of the entities involved. In all cases, it's essential to conduct due diligence and thoroughly understand the implications of these financial transactions. As always, the goal is to make informed, strategic decisions that align with your financial goals and risk tolerance. Remember, understanding these terms is a step towards making informed investment decisions. Thank you for joining us on this journey into the world of finance. Stay tuned for more deep dives into complex financial terms.